Money today is different from money in the past. Before 1968, money was backed by gold. After 1968, it no longer was. That change fundamentally altered the nature of our economic system. It caused capitalism to evolve into creditism, and in the process, it transformed the world. This video will document the extraordinary expansion of the money supply after 1968 and emphasize that this world-changing surge in the money supply could not have occurred if money had continued to be backed by gold. This is the 9th video in the Creditism 101 series. Everything in this video is explained in much greater detail in the first 160 pages of my book, The Money Revolution: How to Finance the Next American Century. The monetary base and M2 are the two main monetary aggregates monitored by economists and investors. The monetary base, also known as base money, is the money that the Fed creates. M2 is created primarily by commercial banks. Before 1968, the monetary base was directly backed by the gold held by the Fed, while M2 was indirectly backed by the gold held by the Fed. In 1968, however, both ceased to be backed by gold. The monetary base is made up of bank reserves plus currency in circulation. The Fed expands the monetary base by creating bank reserves. The monetary base surged in World War I and in World War II, and again in the 1960s when the Fed helped finance U.S. government debt by creating money and buying government bonds. This chart shows the monetary base and its two components up to 1968. The monetary base is in black, Federal Reserve notes, or currency in circulation, in green, and bank reserves in red. The Fed creates money by creating bank reserves. It does this either through discounting operations or through open market operations. In discounting operations, the Fed creates money and lends it to a bank in exchange for collateral. In open market operations, the Fed creates money and uses it to buy bonds, either government bonds or bonds issued or guaranteed by Fannie Mae and Freddie Mac. When the Fed makes a loan to a bank in exchange for collateral, that collateral is recorded as an asset on the Fed's balance sheet. In exchange for that collateral, the Fed makes a deposit into that bank's reserve account at the Fed, adding to that bank's bank reserves. That causes an expansion of bank reserves on the liability side of the Fed's balance sheet. Likewise, when the Fed buys a government bond from a bank, that bond is recorded as an asset on the Fed's balance sheet. To pay for the bond it acquires, the Fed makes a deposit into the reserve account of the bank from which it buys the bond, adding to that bank's reserve balances and thereby to the level of bank reserves throughout the banking system. In both cases, lending operations and open market operations, the money that the Fed deposits is not money that previously existed. The act of making the deposits creates the money, or more precisely, it creates bank reserves, one of the two components of the monetary base.